Welcome to SmithWeekly Discussions, an occasional program for our members at SmithWeekly Research. Please note this program is a private discussion and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position, along with your favorite beverage, to enjoy the discussion. We remind our audience to examine our show notes attached to each of our shows to better understand how our program functions. Before we get into our discussion, we want to say thanks for questions coming from our audience at SmithWeekly, including Hugh J., Paul M., Andy S., and Sean M. Brand new guest on the show today, longtime uranium business and sector veteran Jim Cornell has joined us. Jim is the president of NuCore Energy, a private nuclear fuel consultancy that spans the fuel cycle. NuCore has existing relationships with Traxys Worldwide and uranium producers such as NuCore Energy. You can learn more about Jim and the company via its website, NuCoreEnergy.com, or by emailing him, jcornell@NuCoreEnergy.com. Jim, welcome. How are you?
Thanks a lot, Andrew, and thank you for the introduction. It was very nice.
Well, good to chat. We have so much to chat about, but I don't think we're going to be able to cover it in one program, but it's great to have you on finally. You know, one of the things I want to do here just for the audience, because I think you're underknown in this sector, at least from the investor side, and most of them anyway. Talk about your experience in this sector, and maybe just kick us off with your story, just how you got interested in this sector, and then maybe just walk us through some of the highlights, good and bad times, cocktails, etc., throughout your career.
Sure. I graduated from Cornell University Business School in '78 and actually went into the tax advisory field, working for what was then Ernst & Young. It was dreadfully boring, and a friend of mine from undergraduate school at Wesleyan University rescued me from that. And at the time, the coal industry was undergoing a tremendous renaissance as a result of the oil crisis. And so I became a coal trader, and I did that for about 9 years. At one point, that the industry flip-flopped and was on. The trading companies were disappearing. So I looked for another commodity to apply my experience and talent to, and sort of came upon the uranium industry. And at that time, it was this is back in 1987. The trading it was almost non-existent in the industry. There was some and they were trading enrichment services, and that was about it. And I was brought on by a company called NuChem to develop a trading capability, and enjoyed a tremendous amount of success in that. I was with NuChem for about 25 years and was president and CEO of the company for 12. And during that time, the company went from a fairly modest uranium brokerage or business to the largest uranium trading company globally. We were doing revenues up between $750 and $1 billion, and EBITDA between 100 and 200 billion for almost 12 to 15 year period. The company was sold in 2008 to Advent International. Ultimately, it was acquired by Cameco. But by that time, I had left the company, and I had started up with NuCore Energy, which is I'm still working with today. NuCore Energy was originally established as a portfolio company of a private equity firm, Cadent Energy Partners. At the time, I ended up managing an $80 million portfolio for them, and we were investing in uranium equities. A lot of the juniors that are still up and running today, and a lot of the exploration companies. We also tried to acquire UPC at the time. We were attempted to start our own fund, so I have a lot of fund experience. And then after Fukushima, I focused pretty much all of my attention on doing marketing and other advisory work in terms of financing, and also M&A work for NuCore Energy. And I worked very closely with Traxys as an advisor on broadening their supply base. Traxys is one of the largest trading uranium trading companies in the space right now, and NuCore Energy was one of their more the lowest cost and one of very successful producer for a number of years until the market declined within, like, say, 3 or 4 years ago. That brings me up to today, and I'm still advising both of those companies, and we're looking for opportunities to take advantage of this recent improvement in the entire sector.
Jim, is it safe to say that just about every component of this industry, fuel buyers to the trading side, government relations and policy side? I know you have a view on nuclear power, but all the way down to bringing material out of the ground with the miners. Did I miss anything? You pretty much covered it all.
I think I've been involved with the trading, not only uranium, but conversion services, enrichment services, secondary supply. Biggest, NuChem was the largest acquirer and reseller of secondary supply, and coming from areas such as Kazakhstan. We participated in the Russian-US HEU deal, was responsible for converting 22,000 Russian nuclear missiles into civilian fuel for US reactors. I've been across the board. I've been selling to every single utility in the world, and familiar with just about every mining and exploration company.
Take us back to, well, I'll tell you what, why don't you give us your view of this uranium business today? Certainly on the uranium side, the supply side, talk about where we are today and where do you think we are in this trend?
Well, what we've experienced over the last several years has been a reduction in production. You've seen the Kazakhs have cut back significantly. Cameco, of course, shut down McArthur River. Then, of course, there was the increased reductions as a result of the pandemic. We see the mines, the Uranium mine shut down in Niger, in Namibia. Paladin is shut down. Australia, ERA shut down. As a result of the reserves finally running out. But so what you've seen is a reduction in supply, and at the same time, and you see a reduction in underfeeding, which was generated by excess enrichment capacity. Up till a year ago, was generating about 24 million pounds of uranium, and that was all being sold into the spot market at really was a clearing cost of, it's well below market. And that's drying up because enrichment prices have increased, and also we've seen Russia, that which was a major exporter and supplier of uranium, they're becoming transitioning toward being a net buyer as a result of their very robust reactor build program internationally. So those are the dynamics that have been affecting the market. We see at the same time that there's going on with that reduction in demand. You have this recent development where investors are willing to fund companies who are going out and purchasing uranium. Now, just to put that in perspective, the only company that I can recall, that only production company or exploration company that went out and purchased uranium speculatively in the past was Paladin. And that was probably somewhere in 2005. They had a bad experience, and it didn't last long. They invested $10 million in uranium, and then the prices shifted and they ended that sort of business initiative. But recently, this year, we've seen, number of companies going out and purchasing, companies that aren't even production, company like Denison buying 2.5 million pounds on the market. Boss Resources. In addition, Cameco has always been buying uranium to meet their contractual needs, but this new buying activity is pretty unique, and that is further reduced the amount of available material that can be sold on the spot market. So, all of this activity, and then of course you have Yellowcake buying up to 1 million pounds of Kazakh production per year. They've already developed, built an inventory of 13 million pounds consisting exclusively of Kazakh U3O8. So all of this material that could, the combination of material being pulled off the market through purchases, you have underfeeding declining at a very high rate from 24 million down below 10 million per year, and also mine closures. The combination of those has resulted in a situation that I don't think anybody could have foreseen a year ago.
It's a perfect storm. Lots of different components here that you mentioned. We've seen the juniors come out, and some of them, of course, come out and buy some material for future delivery. You have UPC being rebranded with Sprott. The physical funds are ramping up somewhat the buying efforts, such as Yellowcake, as you mentioned. They exercised their 2021 option. I'm still scratching my head why they didn't use their 2020 option. Jim, maybe you have some views on that, but I've struggled to see why they didn't make that action with Kazatomprom. My suspicion is was probably a gentleman's agreement on that front not to do that. We have a lot of good things going on, but I want to go back to just a moment to secondary supply, specifically underfeeding, largely a survival technique for the enrichers, while, of course, the services side dried up post-Fukushima. What's your expectation of underfeeding, say, over the next 5 years? Will it remain to be below 10 million, below 5 million? What's your thought process on that as the cycle gets underway?
It's highly dependent on enrichment prices, and those prices, there's a new contracting cycle in enrichment. It usually lasts about 10 years, and as some of these new contracts come up, these enrichers can't supply enrichment from new equipment for $50 a SWU. They're just able to supply at those levels from legacy production. And so a lot of them, that you've seen over the years is you only have 3 enrichment companies, the primary ones, Orano, Urenco, and 10X Rosatom. And the time they've not been replacing equipment. They've been just using existing equipment, and when it's no longer operable, they shut it down. The centrifuge technology allows you to sort of separate, to isolate equipment that's no longer viable from the rest of the equipment. So it's been very easy for them to sort of move gradually toward adjusting their production to what the actual demand is. And what we've seen here is that as a result, there's less and less enrichment available just to produce uranium. They've been able to improve the economics of the entire enrichment process to the point where it's going to, there's less and less of a need to produce uranium, and that's why it's gone down pretty significantly. I think there'll still be, through the end of this decade, there will continue to be uranium generated from underfeeding, but it will probably be in the range of 5 to 8 million pounds per year, and so that's a major shift, because I think the low pricing that we've seen over the last 3 years has been pretty much a result of underfeeding, because they don't really have their costs are variable, and they can essentially be economic at any price level, similar to, say, a BHP, which is producing uranium as a byproduct.
So when the SWU price declined, it was simply a matter of survival. Everybody who has enrichment capacity is going to turn around and just create and sell it into the market.
See, with enrichment, usually enrichment is sold under what they call requirement contracts. So as long as a power plant is operating, they are obligated to take delivery of the enrichment service. In the case of Japan, almost all of the enrichment contracts were that type, a requirement contract, whereas that wasn't the case though for the uranium and for conversion. So immediately when those reactors were shut down in Japan, the enrichment producers had nowhere to go. I mean, there was no way they could find another customer because it's, like I said earlier, there's a very long contracting cycle, and there's almost the spot market for enrichment is minuscule relative to uranium, and conversion is also is not very robust either. But say it was, so they had no spot market outlet, and the only thing they could do to keep those centrifuges running, which if you shut them down, you can never restart them, is they generated uranium with them. And so that led to a flood of extremely low cost uranium onto the market and really severely depressed prices.
Yep, exactly. That's important to point out. We're not going to spend any money here. You can see the result. Lack of capital, even to this day, very little capital going back into this particular portion of the fuel cycle. And so until we get, I'm not sure what price they need. You know probably better than I do, but you said 50 is not enough. So for SWU prices, do they need $100 to start buying new equipment and commissioning that, which I'm sure is a multi-year process? What's your thoughts on when they start to capitalize with more equipment?
You know, it used to be where they would, they needed over, $100 per SWU to justify, adding new capacity. So one thing is they might, replacement, I think they're, unless, most of them, when they, like for instance, when Urenco, which started out with a very small capacity, maybe a couple of 2-3 million SWU per year, and built it up to 15 million per year. They did it only, they would not add new capacity unless there was a contract that would support it. So I think there's going to be, and they're talking not a 3-year contract, a 5-year contract, but at least a minimum of 10 years. And so I don't see additional capacity coming on until prices get up near that, $100 level.
Yeah, certainty with contracts, high market prices, beautiful setup for an investor who's looking to enter into this sector. So come back for a moment and let's go back to that time period of the early 2000s. I was too stupid to look at the uranium sector back then, but you were there. Talk about the thought process and what you were doing at that time. And you were looking at the market. You were doing more than just trading uranium, but you were also involved with looking at equities, analysis of equities, et cetera. When did you think that things were starting to become unraveled in the sector? Was it when you saw the uranium price, come up to that 130 plus level? When did you see that it was starting to get where a lot of production was coming on, mines were getting financed? And don't talk about Fukushima yet, but did anything come up at that point for you that said, this is starting to look like it's overheated?
Well, yeah, what happened, just to go, the early 2000s was not a very promising period for nuclear. At that time, there was the issues that the utilities were dealing with in the U.S. were stranded costs, how they would deal with that, and writing off huge investments that they really were that needed to be funded somehow. And the other thing was plant life extension. The plant at that time, if you had absent plant life extension, most of the plants in the country would have shut down by 2015. And the first plant that went up for applied for plant life extension was Vermont Yankee, and they withdrew their application. And then there was the Monticello plant out in Wisconsin, and they withdrew their application. So people started thinking, whoa, this is not this industry looks like it's going to be over before long. And then what happened was all of these utilities started improving their operations significantly. I mean, going from capacity factors of somewhere 70%, 65% up above 90. And I think that operational success really contributed to a major turnaround in the industry. And that started, and that spread throughout the world. All, operationally reactive performance reached its peak, I think, after, say, after 2005 to 2011. I mean, we saw at that time the Koreans were projecting to double the number of the Japanese were going to go from 54 reactors up to 100. I mean, it was the promise for nuclear at that time was just mind-boggling for anybody who'd been in the industry for any length of time. And of course, China was projected to go to 125 to 150 gigs by 2030. So, we were looking at an extremely optimistic scenario. And that's when there was something like, I think, 500 combination of junior mining companies, exploration, developers. It was a true renaissance. And of course, with Fukushima, you have then that whole renaissance unraveled.
There's just lots of pieces to it here, and I know no one would have ever thought that things like megatons to megawatts, plus a high price environment, plus Fukushima would derail what has happened here. That, of course, has set up what we have before us today. Talk about for a moment the behavior, for example, today, maybe in your experience, because you've got to see this, whereas a lot of people, at least some of the people on the investor side, these people weren't even investors in the early 2000s, and not necessarily in the industry, but certainly on the investment, the capital side, haven't gone through this cycle before. But is there any difference in behavior, Jim, today at the fuel cycle level and also at the utility level? Is there any difference in behavior, Jim, or is it more or less the same type of behavior?
I think the biggest changes that have taken place are the decline in secondary supply. That's been happening, it's been very gradual. Like you said, the megatons to megawatts deal was responsible for about 24 million pounds a year. That was replaced, of course, by this underfeeding, which almost, matched it. But now that underfeeding's, coming to and drawing to a close, there's that, that's been one development. On the utility sector, there was a tremendous amount of consolidation. There was so many companies that you have Northeast Utilities. It was Boston, New England Power. There was Portland Gas and Electric. There was San Diego Power. I mean, there's in Texas there were 2 utilities. There's so much consolidation that's taken place. So now there's probably 6 major U.S. utilities and then several smaller ones, and that's been a big change. Which also was a big change was the development of deregulation of the power markets, and now half of when I first started, all of the utilities were regulated, and they all had to apply for rate increases, and everything, all the fuel that they purchased could be passed through to the ratepayers. And then over time, in the early 2000s, you had the development of merchant plants where they had to stand on their own, and half of the U.S. fleet now is merchant plants, which are very vulnerable to the ups and downs of the power markets. That's really changed the economics of them. So the companies like Duke, which are fully regulated, they don't have to worry about their fuel costs as much or the economics, because they can pass this off to the ratepayer. But then you have a company like Exelon, which a lot of their units are merchant plants. They have to achieve the lowest cost possible, and that that affects their buying decisions and practices. They can't afford to. They have to go and seek out the lowest cost possible to keep those plants operating. So that's been a trend that developed in the like I say early 2000s and has really shaped the industry quite a bit today. We still have the same. Well, there were more converters. There was BNFL in England. They shut down their conversion plant. And here in the U.S., we had another conversion plant, Kerr-McGee, and they consolidated with Allied Signal, and now you have, and Allied Signal was acquired by Honeywell. So now you have one plant, and that plant was almost shut down permanently, thank goodness, for the uranium market that they're planning to reopen in 2023, because if you didn't, you would have essentially the uranium market would alter significantly. It would turn into just a natural US 6 market. So that's happened. We've seen the enrichment consolidation, Urenco and Orano. They're using the same technology. They've had only enricher here in the US shut down pretty much permanently. I know that Centrus is trying to revive the centrifuge, but on a very limited level. So we lost a major. You had the US Enrichment Corp. That was supplier of enrichment services, and that was the end of the phase out of gaseous diffusion technology and replacement with centrifuge technology. You see them in mining, where you've gone from open pit deep mines to now pretty much ISR is pretty much the exclusive mining technique, except where you'd have areas in Saskatchewan where there's very high grades. So these have been that's because you've had to have the lowest cost possible, and those are the trends that have developed and continue on till today. And I think that's it's like these streams that continue and go off and branch off, but it's really been, I say the whole industry has changed significantly since I've been in it.
Jim, the lead time is so important to point out to the audience. Metropolis 2023, SMR fuel cycle procurement, where we want to start the plant 2027. What do we do in 2023, 2024? I think that's important for people to realize the lead time in the sector, and it goes both ways. I want to take a break from uranium for a second. I want to go to the broader nuclear energy side of things for a moment. First off, I'd like to get your view on nuclear power and how nuclear power is a solution to climate change. Should you see that that's a substantial issue? I'd like to hear that. And then also, I'd like to know from you, what country is leading the nuclear charge? Is it China? Is it Russia? The turnkey programs? Where does the U.S. fall in here? What does the U.S. need to do? I know that's a lot, but take it away.
I absolutely. I think global warming is certainly an issue, but it's not. I think there's a lot of global warming hysteria, but I think what nuclear's contribution is carbon free and electricity generation, and to the extent that carbon is a pollutant, I think it's important to minimize it. And half of our carbon-free electricity in this country is generated by nuclear. And importantly, nuclear has a very small footprint per kilowatt. I mean, the nuclear power plants are very compact, unlike the requirements for wind power and especially solar power, which requires a tremendous amount of land area. People are fixated on this older technology, because these plants we see in the U.S. they have operating licenses go for 60 or 80 years. The French are looking to do the same thing. So these plants have a much longer life than anybody envisioned when they were first built. And so we're relying on very old technology, the light water reactor technology, and yet in between that period of time, there's been major improvements that really are not recognized by the power generating community. And really, well, a lot of this technology is being deployed, though, is Japan, and Russia. So they're building China's building what generation 4, and looking for the generation 5. Essentially, plants that are going to be meltdown proof and almost fully automated, and they're providing so much support for nuclear that they're going to naturally take the leadership role in which technology is adopted, which one will ultimately be deployed throughout the world, because both China and Russia are driven. They're some of their biggest export items are nuclear power plants. And I think a lot of people don't pay much attention to that. But if you take the case right now of Argentina, they're in dialogue with China, and now Russia's coming into that dialogue to acquire a new nuclear power plants, and also power plant, nuclear power plants that are deployed on barges. Now, the U.S. isn't in that dialogue. We've sort of lost our leadership role. I know we watched this, they talk about it, but in terms of any type of substantive development, I don't see where anything exists. I mean, you have Russia going into Turkey, which is a NATO ally, and building nuclear power plants. They're building them. They're operating. They're doing it under operating and sales arrangement, where they produce the power and sell the power onto the grid themselves and take the risk of operating it. You have the Russians looking at building in Egypt. They're building in Bangladesh. The Chinese are in Pakistan. The Russians are building in India. They're building in China. We've really seen that this is the future of nuclear is really in the hands of Russia and China. And unfortunately for us, we might end up buying a future nuclear power plant from one of those countries.
Business is open, I would say that, and these countries you mentioned is just it's the first step to some degree, because you have a lot of other countries who will certainly entertain mid-size, conventional nuclear, SMR. The maritime application is mostly ran by Russia for the most part, their icebreakers and their floating plants. It's an interesting state of affairs, and you and I have talked in the past. It's going to require some capital if the U.S. wants to come back into this. I think that they have the capability to do so, but they need to lead. And to lead, you need some smart people at the top to understand that energy is a huge importance, national security importance, strategic importance. We know that Russia likes to use these vehicles for control, command and conquer type setups. Maybe don't own anything, but control everything type thought process. It needs to be challenged, and the U.S. still has that capability, but it's going to require some serious capital and some people to come in and manage that and handle it. Quite frankly, now is a fantastic time to do so. Let's go back to traders for a moment. You've got a lot of experience in this part of the sector with your relationship with Traxxas. Talk about the importance of traders in this marketplace, and of course, traders as a very heavy importance for those companies who may develop a mine that may not get a contract, but may have quantities sufficient to use traders to take care of their books. What's your thoughts on traders' impact on this market?
Well, traders, unfortunately, they're object of scorn from a lot of members of the community, because they don't understand what traders, what benefit they provide. Mostly, it's a logistic and financing function. The mining company, the nature of contracting to supply uranium, is one where you can't really control the delivery dates, because that's something that really your customer is insisting on controlling. They want to take delivery when they need it at the place that they need it. So there's a number of uranium is delivered to conversion facilities. There's one in France, and there's one in the US, and there's one in Canada. So there's 3 places where you can deliver your uranium. And when either a trader or a producer contracts with a utility, that utility has the right to declare the delivery date and the delivery location that they would expect to get, the product. Now, for a mining company, especially a smaller one, and I'm not talking about the Camecos of the world or BHPs, but I'm talking about a company that would have production of, say, 1 million to 2 million pounds. It's very expensive for them to maintain inventories at all 3 locations that would allow them to meet those delivery requirements. Also, most of them require funding and can't afford, don't have the banking relationships that permit them to be able to wait several months to get paid. And if they're producing material evenly through the year and the deliveries all take place in the 3rd or 4th quarter, they have a significant funding requirement. And that's where a trading company comes in. A trading company can provide financing for them. They can take delivery of that in the 1st quarter and then deliver that to the utility in the 3rd or 4th quarter, because they're set up, usually have fairly large lines of credit at attractive rates. They also are able to swap uranium around. They have enough relationships where they can move uranium just via swapping from, say, a ConverDyn to an Urano facility or up to Cameco. So the basic function of a trader is to create a market, an immediate market for a producer, and also be able to address those logistics requirements that would otherwise be prohibitively expensive for a smaller mining company. And that's the role that they've traditionally played. They've done that also with, bringing secondary supply into the market, when, smoothing out the delivery of that secondary supply, providing a market for it. That also has been very critical. So they've been a very important player in the market since the 1980s.
I appreciate you pointing that out, because I think that there's a good chunk of audience that probably didn't know all of those features and components, and that's important to point out that they serve an important component in this market, both on the bull side and on the bear side. Maybe this is a good time to switch over here for just a sec. Let's move to the majors, the ones who have those credit lines, the ones who have those finances, the ones that can do these things maybe without traders. You've got a reduction, you've seen Rio, you've seen BHP generally exit this sector for now, Jim, and maybe you can speak to them for a second here, and maybe what their thought process will be, and others, when the uranium price is much higher. But you've seen them exit. You've got mostly Kazatomprom, Cameco, Uranium One. What have they done right? And I know you're certainly familiar with Kazatomprom and Cameco, but what have they done right over the last 10 years, and where do you think they've gone astray?
Well, Kazatomprom, it's interesting that NuChem we engaged with the former Soviet Union republics right after the breakup. We had been doing a significant amount of business with the Russians, with the Soviets before that breakup, but afterward we went in and essentially established supply relationships on an exclusive basis with all of the stands: Uzbekistan, Kazakhstan, Kyrgyzstan, Tajikistan. And so I was involved. I spent 15 years working closely with the Kazakhs, and saw them, grow from a company that was challenged to meet its contractual obligations to literally, the #1 uranium producer in the world. And they've done, they've done a fantastic job. They're blessed with the best deposits in the world. They're all ISR amenable. They've shut down any of their high cost operations. So that they've done, what they did early on was they decided to go out and create, I call it the United Nations of uranium, where they set up joint ventures with most of the major players in the market, not the utilities, but with Japanese trading firms, with Cameco, with Orano. They are also with the Chinese. Those joint ventures served them very well. It provided them with capital that they didn't have, and expertise, mining expertise that they didn't have. And so they've done a really extraordinary job. And I think they would be, surprised if someone had said to me that in 2000 that the Kazakhs would be producing 58 million pounds in 2021. I would have said, you're crazy. But they really managed to do that. They have total market power. I mean, they're the largest producer. They're the Saudi Arabia of the market. They set up this yellow cake. They supported yellow cake on the very favorable terms in order to try to take pressure off the market when they had excess supply. They wanted to generate a price of $70. They could do that tomorrow, but if they could get the cooperation of their partners, because they have that marginal production that and they can turn it off and on very, very easily, as we've seen with their response to COVID. Cameco, I think they were smart to get in, and they acquired Uranium, which was their partner, their German partner, who had already a stake in Kazakhstan. John Borshoff was with Uranium at the time. He was one of their chief mine operator. Also, Uranium owned big share of the other Cameco projects. So Cameco did a smart thing by buying out Uranium, especially in the assets they had that were the lowest cost production. I would say, they've had to respond to the market weakness by doing the right thing. They cut back, they shut down McArthur River. Their production now, their total share of production it's been cut in half. So they've been doing everything they possibly can to bring supply and demand to balance. Of course, they have to be careful because the Kazakhs they're very happy to expand and take over market share that anybody else has decided to give up. And we know that they could increase production significantly if they want to. So I think Cameco's would probably have kept the guard down for a longer period of time in order to get market fundamentals back in balance sooner. But they've got to be careful that they don't concede market share to Kazatomprom. Uranium One, that was one of the smartest investment that they made was in Kazakhstan, and that's helping to support the fuel commitments they've made as a result of their reactor sales throughout the world. Because when they sell a reactor, they sell fuel for the life of the plant. So having that, their uranium production in Russia is pretty high cost. And having access to 11, 12 million pounds of Kazakh uranium allows them to be competitive with part of their reactor sales package. So those are, the bigger producers. Now, except BHP, of course, has been in a very preferred position. Their costs are probably the lowest in the industry because they're a byproduct of their copper production. And I think that, one thing, in the past, of course, they were looking at expanding Olympic Dam and bringing uranium production potentially up to 20 million pounds a year. I think it's fortunate for the rest of the mining community that that's not going to happen, because that's a lot of uranium, low cost uranium that would make its way onto the spot market. So that's a positive effect for the uranium market, is that decision not to expand Olympic Dam.
Jim, I think you covered most of it. You hit the bulk of it, but yeah, you're right. Olympic Dam. Look, let's keep our fingers crossed. The copper price, I suspect, will go substantially higher from here. It's possible we could see double-digit copper before this is over. So they'll throw that back on the table. Of course you would. With that kind of copper price, you can do a lot, but the expansion time is going to be a long period. So that's a part that people need to calculate into their figures. With Rio and ERA, when the uranium price is at a higher price, let's just assume $80 a pound, $100 a pound, whatever. The projects at Ranger and also Jabiluka probably gain some attraction yet again. When those times come, I think that's a lot's already happened really well for the sector. With regards to Cameco, I'd like to pick on Cameco, but Kazatomprom too, like you mentioned, the capitalization into the new projects, into the pipeline, that hasn't happened even with Kazatomprom. We know that they'll get the capital in the future to do this, but right now, both Kazatomprom and Cameco haven't capitalized any type of expansion and pipeline building for their depletion. Now we know that there's care and maintenance and such things that have delayed that, but one of the things that we've pointed out is, Cameco, for example, has 7 to 10 years of runway in their existing projects, and they need to perform M&A and work on their pipeline. And Kazatomprom, too, to some degree, needs to capitalize a number of things as well if they're going to continue to be a force, because they're in decline mode as well. And so
I think a follow-up on what you just said is that, yeah, I think a lot of people are not aware of the fact that cigar at current production levels of 18 to 20 million pounds a year, it will run out of resource in 7-10 years. And you're right, what is going to replace that? And certainly if you look at what Cameco, what they took to develop cigar, I don't know if it was 30 years. I mean, and they ran into some, flooding on 2 occasions. The cost there, even though their cash costs might be, very low, if you took their all-in costs for the 30 years of development and all that, they have to be, I don't know, $50 to $70 a pound. If they really did, if they included all of the legacy costs that were involved in developing that project. And,
right.
and in Kazakhstan, we've evaluated a lot of the properties there over the years, and the true cost there, both Cameco and Kazatomprom need $45 price to justify production. They can get by with this market of 30, but they are not going to be able to invest. I don't think they would, and I don't think they should invest in new production until they can get it at least that price. And that's pretty. They both said that publicly. Kazatomprom, everybody looks at their very low cash costs and their replacement costs. When you take in what it the cost that what they account for, which is community costs, government taxes, things like that. Same thing. They need $45 to justify their production. So, and they've been high grading for years. They're going to be running out of low cost uranium probably by 2027, between 25 and 28. And they're going to have to tap into those much deeper deposits, and the pumping costs are much more expensive. It's going to, their costs will go up significantly. They've acknowledged that they're high grading, and they're just doing that to continue to support, pay off debt and support their local communities that were set up to support the mining activity. So I think we're heading in that direction. And I think when the market's becomes more aware of the fact that this low cost uranium is quickly drying up, both on the secondary market level and the primary market level, I think that's when prices will experience that real lift. And it's just a matter of getting it to that point.
If you had $500 million, would buying uranium at current prices, $27, $25, $33, given what you know in this sector, would it matter to you to accumulate at this point?
Would I think it's a good idea, or is it?
Absolutely. Do you think it's a good idea to buy, not split hairs, but to buy at these current levels?
Oh, yeah, this is a bargain.
Yeah.
I think everybody, you should be loading the boat at a price level like this, because you have to look at who can produce at $30. I mean, that's why. I mean, you see the thinking behind all of the junior miners and explorers buying uranium is that they know what their costs are. They know that there's no way they can produce at $30, so they figured, we'll buy it. And because they know at some point that the market is going to have to increase in order to support, actually bringing mines on, and they'll be sitting there with uranium and making a pretty, hefty profit on it. I think it's a very smart thing, and I think to the extent that companies can continue to attract funding to pursue additional uranium acquisitions, I would think you would continue to do it until you weren't able to raise any more money. It's really a smart thing to do.
Absolutely, fully agreed. And we'll see what Sprott and UPC does here as far as can retail investors buy those units and force them to continue to buy uranium. That's going to be an interesting setup if they can structure that correctly. How about this? What makes a good uranium mining business, Jim? Is it people?
Absolutely. Well, I think it's your deposit, your capex, and operating costs. Starting with the deposit that is amenable to ISR, where it has the lowest capex possible and flexibility. Of course, would have the very lowest operating costs. I think that's the function of your personnel, people there who can identify those deposits and know how to extract the uranium at the lowest cost possible, and to also bring these capital projects on budget, and work their way through the regulatory challenges that the mining community face. That people don't realize how long it takes to permit these mines, and what the regulatory maze that you have to negotiate through. So it's those unsung heroes there, that your geologists, your operations people, guys who understand the chemistry. They have these guys who understand what's going on underground, and without having the possibility of actually seeing it. Those guys are really what those people would make or break a company. And they often not mentioned in these PowerPoint presentations.
Yeah, that's about right. Just in recent experience, the only junior company, and this is not in uranium, but multi-billion-dollar projects, is I have to highlight Ivanhoe Mines, 2 projects, South Africa and the DRC, copper and PGMs, both projects that require billion-plus capex. They're being advanced at the same time. So we'll give some credit to those folks. But when you go back and you look at this, let's use Cameco, for example. We've seen Cameco do MacArthur and Cigar. These projects were generally advanced and constructed mostly during prior management. Now let me couple that with a large capex like NextGen, a large capex like Fission. There's not too many other deposits I can think of globally from a publicly listed company standpoint that qualify for billion-plus capex. What do you think? These big projects that require billion-plus capex, can these management teams deliver on that?
Well, it's certainly facing a pretty serious challenge. I mean, the reason I mentioned earlier why you're looking for a project that has a small capex, and we've disclosed that I have been advising NuCore Energy for 10 years, and the traction of that, they could build a processing plant and set up well fields at that time for $80 million, and expansion is only going to cost them between 10 and 20 million. It's easy. We went out and got contracts to support that new build, and got a favorable financing package from the state of Wyoming, but based upon the contracts that we entered into with U.S. utilities. And I think that's generally how these projects are financed. It's going to be hard just to do it 100% with equity. You're going to have a debt component, and the debt, if these banks don't want to secure the debt with a mining project that they wouldn't know what to do with if it was foreclosed. So they want to look toward a consumer that's willing to pay a price that's going to guarantee a return, and most importantly, the repayment of the loan. So when you look at $1 billion project, the contracting effort that would be required to support that capex is huge. I mean, it's daunting. You'd have to go out and find utilities who are willing to make a 10-year commitment to fund, to allow that, that company to go out and raise, significant amount of debt. That's why I've leaned toward companies that have, a modest capex that doesn't require, 10-year take or pay contract, because I think utilities are going to be a little reluctant to do that. I mean, I think their first, their preference would be to go to say a 5-year contract with someone at a certain modest volume, so they're not putting all their eggs in one basket. So we'll see, but I think that a next gen and fission have quite a challenge ahead of them.
I purposely don't include Denison there because of the capex of those projects is substantially less. But yeah, you bring up a lot of points, the time frames. Not to say that those equities don't rise in this market. I'm not saying that at all. I'm just saying, can you get to that level of actually financing it first and actually getting into commissioning and actually delivering cake in a can, which is a whole nother challenge in itself. And then, of course, there's the M&A component you and I touched on earlier. At what point is there pipeline building being done in this sector to replenish depletion? New companies who are looking to build a mining company that can stay around for multiple decades. We saw that last time, attempts to do that. So it'll be interesting to see what happens this time around.
If you just look at the situation today, these companies are raising money to buy uranium, not to build out the mine. So there's already, this is sort of an intermediate phase where they've decided that, it's not possible to contract for, for uranium supply. So they're able to raise money, and they're just made a decision to buy uranium, not even put any of that equity into building out their operation. I think that's very telling. And a lot of people just don't, they're saying it is if it's a smart move. Yeah, if you can raise money and buy uranium, that's all great. But the economic determination is that you're better off doing that than doing any exploration work or starting to build out your production facility. On Denison, Denison, if they are able to use in situ recovery on their project, of course, that would be a game changer. That you could access an ore body that such high concentrations of such high ore grade through ISR. That would certainly make them, I think they would be more competitive than the Kazakhs. So we'll see. I mean, wish them luck.
Yeah, let's see what happens on that front. I mean, they do certainly have deep pockets in regards to finance and also technical capabilities, given the Lundin Group, as you know, does everything. I guess uranium you can exclude at this time, but certainly from oil and gas, copper, gold, etc., they've pretty much done it or know someone that can. So let's see what happens on that front. But you're right, it would be an interesting component. And their capex, again, depending on what project we're talking about, whether we're talking about Phoenix or Griffin, we'll see what they do there. It is interesting, the points about the physical uranium buying by the juniors. Some of them, as you and I discussed before, we see that proper M&A of good, mineable, meaningful pounds that are in the ground, good projects that we know that we can actually permit, commission, and actually produce cake in a can. I think that is money best spent first and foremost. But you're right. I think that there's a number of companies that could buy a stock of uranium and provide, a 2x, 3x upside in the price, which is, to me, a cash equivalent, and then also provide buffer for potential contracts if they get one to get their project up and going. There's some good use to that. What's your thoughts on laser enrichment?
Well, Silex has, we looked at, I evaluated the Silex technology when we looked at, evaluated whether it made sense to acquire a stake in that when GE was selling their share. For Silex, there was Avlis, which was also a laser technology. And they used to say about Avlis, you'll see Elvis before you see Avlis. And I think that I don't know who you'd say would something similar with Silex. I don't think you're ever gonna, the capex is really significant. And the project that they're working on right now with enriching tails at the former government enrichment site at Paducah, Kentucky, it's like a $2 billion investment, and it would produce somewhere in the order of 10 million pounds of uranium at a fairly, if everything worked as planned, it would do it. Everything would be a very low cost production. That's what Cameco's still in it and supporting that, together with Silex. I don't know, they're spending between 5 and 10 million a year to keep it going. But I just think that the capex is too high, and I know they have challenges on scaling it to the level. And that project that would only be to produce uranium. That would be with a less complicated version of the enrichment equipment. So then on top of that, to really have it establish a standalone enrichment capability, they'd have to build another plant. So right now it's set up to mine DOE tails, but I'm very skeptical that will ever see the light of day. I don't see how they can raise that $2 billion.
I have the same view. I think this is a long time out if it ever gets there. I guess along those lines, and I don't think it affects what we have before us today, but along those lines, Gitzel's a board member over at Mosaic. You've seen attempts to extract uranium from phosphate. Any thoughts on that?
When I was at NuChem, we purchased uranium from Mosaic. There was also, I forgot the other company that was mining phosphate in the Louisiana area. We go down. It was a nice, it was a nice opportunity to go down and spend a couple of days in New Orleans, and then go see Mosaic. They had Tampa. The issue there has always been environmental. We tried to, when I was at NuChem, we were going to fund the construction of a circuit that would process old phosphate tails at one of the Mosaic facilities in outside of Tampa. But the project ran into, we did a thorough investigation and analysis of it, but really ran into environmental issues because they didn't, once these tailing piles are there, it's fine, but once you disturb them, there's a concern that there's going to be new runoff and potential contamination. So I think that that's the issue that these phosphate producers are going to run into when it comes to uranium. All you have to do is mention, like, oh, you're doing what? You're taking uranium out? We didn't know uranium was in it. People, they're putting fertilizer on their fields. They don't realize they're also spreading uranium. The phosphate, once this comes up, phosphate goes, wait a second. Don't start that's really negative publicity that, put uranium on your cornfield. So I think that's really, I don't really see a big future. I know there was Morocco has some, phosphate deposits that people looked into, but that falls under the category of extracting uranium from seawater. I mean, it's sort of, it worked back then. I think the environmental is challenging.
No, you might need a few $100 a pound to do that. You can throw bananas into it too, potassium and bananas. You can start to look at banana peels and these types of things. Let's move on for just a sec onto another subject here. Just as we start to wrap up here, I want to be respectful of your time, but it's been a good chat. We'll have to do it again. But the inventory buffer, I think this is an area where people are maybe wondering a little bit. Let's talk about U.S. and European utilities for a moment. What would you expect for them to stock on the shelves when they do start to recontract in a heavy fashion? If you go back, the volumes during that period from about 2004, 2005 to 2009, where there was pretty heavy volume contracted. Do you think that the utilities have changed that view? Do they go just in time, especially with coming out of COVID here, we've seen what just in time could do to supply chains, or do they look to actually recontract for 4 to 5 years ahead, like plenty of material to make sure that security of supply, certainty of supply? What's your thoughts?
Well, It used to be traditionally that U.S. utilities would maintain 3-year forward inventory, Europeans 5 and Asian 7. And as a result though of economic pressures on these utilities, especially the merchant plants that I mentioned earlier, that half of the current fleet are merchant plants, they're forced to have more of a just-in-time inventory policy because they don't want to tie up cash. They've been able to manage that. This is something that we call in this industry as a term called negative lead times. And what utilities were able to do, and they can still do it to an extent, is that they can lean on their fuel providers' inventories. So they can actually get delivery of fuel before they buy replacement. And that's because you have to look at this, the company that ultimately supplies fuel to a utility is the fabricator. It's an engineered product, and you have a fabricator like Westinghouse or GE or Urano, or in the case of you have Rosatom in Russia. These are the companies that provide the fuel assemblies that are installed in the reactor and produce the energy. Those companies have been sitting on significant inventories of enriched uranium. Like the Japanese inventories are to a large extent held in an enriched form. It's sitting at places like GE or Westinghouse or Urano, where they were going to have their fuel fabricated. And other utilities that also would have their inventories there. So that large inventories that have been that these fabricators are sitting on, they use them to provide an incentive for utilities to contract with them when they go through the competitive bidding process. And they say, well, we will essentially allow you to use our inventory, and you don't have to use your own. And I think that's been that's been something that's had a big impact on this market. It's invisible to most observers. They don't even put it into their calculation, but to the extent that that changes, that those inventories start to dry up at the fabricator level, then it's going to could change and it could result in a major change in the way in the level of inventory that utilities hold, and it could force them to go out and buy more uranium than they would have otherwise purchased in the more recent past.
Jim, that's a good point, and I hope the audience took note of what you said there. Additional information that I think a lot of people have missed. And do you see these circumstances and these different conditions across the fuel cycle? Do you think that this looks like a situation where it's much worse than the last cycle?
The last cycle, and what was happening prior to Fukushima to me that was really a serious price development. The prices got up above $70 then, and I think that was a real number. That was based upon market supply and demand and what people could see coming down the pipeline. The one time when it went over 100 up to $130, a lot of that is interesting. We'll see what happens now. A lot of that was fueled by UPC. When it first came in the market, they were it was I think it was Cormark Securities was the one that when Peter Grosskopf and Jeff Kennedy were at Cormark, they are the ones who came up with the idea for UPC, and they used NuChem, which I was president of, to aggregate their inventories and so they their purchases because they needed to have a commitment before they went out and raised money. So we would, and they needed to have large volumes. So because they weren't going to go out and raise, $5 million, they wanted, how to raise 20 to 50 million dollars at a clip. So when they did that, it was no one had had seen anything like that. That when they came out and started purchasing it, they immediately tightened up the spot market, and then it was going up at a pretty rapid clip, up until $130. So, go all the way to today, and you see now the Sprott Physical Uranium Trust, which is taking over UPC. Peter Grosskopf is still involved, and I think they've done a tremendous job of, setting up a vehicle that's much more efficient than UPC and professionalizing the management. So, let's see. I mean, if they go out and raise $500 million, I think the market's going to be expecting significant price increases. I'm sure that this, they're trying to buy uranium, I'm sure, at the lowest price possible. That's what their goal will be. But certainly, the expectation in the market is going to be that they'll come in and sort of take out whatever. The spot market is very thin today, and as a result of all this producer purchasing, Cameco still has quite a lot of buying to do, and somewhere around 7-8 million pounds. So if you put Cameco together with, as I say, the potential of the Sprott Trust, you're bringing a lot of purchasing power into the market. And of course, you still have Yellowcake that also has the potential to raise money, as well as a number of other producers. So I think that's why there's a lot of reasons to feel optimistic that prices will, certainly there's no reason for prices to go down, and there's a lot of reasons for prices to go up.
Yeah, I think that's the case. And Peter is still the lead guy over at Sprott. In this current market condition, I wouldn't be surprised that you should be able to raise a couple $100 million, no problem. And just in our experience in writing letters to a number of funds out there, companies that are not involved with uranium, some funds that are involved with natural resources, and then just some that are broad market hedge funds, have no clue about this market at all, Jim. No clue. And these are folks that have billions of dollars under management. It's still very early, and it's a great setup for us folks that know the sector and have placed ourselves in the sector and continue to place ourselves day by day as the sector continues to move around here at what I call still splitting hairs as far as the price levels for most of them. But you're right, it's going to be interesting to see what Sprott turns out here with this vehicle, because this is a pretty powerful setup that we have here. I want to switch just for one moment here before we wrap up. The price reporters of this sector. Now, I know you know who they are. What do you think of them and their business?
At NuChem, we published the price. We had a price for, we were one of the major price publishers. It was us and a company called Nuexco, which became TradeTech. We decided to abandon that because we were a trading business and people were accusing us of conflict of interest. So to avoid any litigation, we ended up selling our price report to Energy Intelligence, which is their publisher. It's not one that people rely on, but they do publish a price, and they do write a very insightful report. But you have today, it's really UX, TradeTech, and to a very large extent, the price is being determined by these brokerage firms, either Uranium Markets, Numerco. They're the ones who are providing the feedback to the publishers. It used to be there was just a monthly price, and then they started publishing a weekly price, and then it's a daily price. And in fact, more with Numerco, it's almost real time that you can get a quote. With all of the brokers, you can pretty much get a quote any time during the day. So I think the thing is that there's very little liquidity in the market still. And a lot of this pricing is based on offers and bids that are not acted on. So that sort of just, they're not, in the case of trade tech, they'll come up and they'll base their price on what they think is the price at time, based upon what bunch of sort of undetermined criteria, let's say. That's like it's their gut feeling of where the price is. And then UX is based on actual transactions, or they look at the broker average price. And that broker average price is provided to them by a couple of brokers. And those prices are generated by not necessarily transactions, by what they feel the offers that they're receiving and bids that they're receiving, even if there's no transaction that results from those. So it can be, in a thin market, it can be easily manipulated. And I think that's happened a number of times. And less when people will get, there's obviously, it generates a lot of bad feelings about that, especially when someone's pricing something at month end, either a delivery or a purchase. So there's a lot of, it's a fairly complex question that you asked. There's a lot of dimensions to it. So there's no one answer to say, yes, this price is more realistic than the other price. The one that probably the UX publishes one that's sort of a monthly average price, where they've been averaging ConverDyn with Cameco. So whereas Trade Tech was publishing a price based upon Cameco only, and it resulted in fairly large spread between deliveries at Cameco versus deliveries at ConverDyn, and I think that sort of eroded some confidence in the price determination.
One of the things I think from an investor standpoint is folks are concerned about, the reporting of price and, of course, the reporting of last long-term contract, et cetera. I just like to caution folks that, just pay attention to the financials. I mean, that will come up eventually. Just be patient there and don't be too caught up in the day-to-day price or the week-to-week price. It's going to work out as we intended. You just got to be patient mostly and follow the key areas. A question from the audience here: uranium stocks have, to some degree, not been caught up too much in general market mania. Jim, if you follow the markets as we do, a separate set of areas in the broad market that have gotten a lot of attention, tech stocks, cryptocurrency. If people are willing to risk money in those sectors, highly speculative, probably not backed by anything. Maybe they are, maybe they're not. Why has the uranium sector, the solid supply demand fundamentals, not caught much attraction yet?
Well, I think a lot of these equities have gone up significantly. I mean, I look at your energy was trading at 55 cents. It's at $1.45 now, and Cameco was at $8. It was getting close to $19, $20. I would say that's in a fairly short period of time. So I think that the sector has gotten a lot of attention, and with the Sprott Trust coming into the market, I'm sure it'll even get more. No, that's not a bad return. More than 130, 40% increases.
And you're understating it too. I mean, if you look at, there's a number of other companies. I'll have to highlight the performance of NuCore Energy, for example. NuCore coming out of the gate 2 years ago, roughly. I don't have my stuff in front of me, but NuCore was a 4 or 5 cent stock. Now it's $1.50 north. There's a lot of stocks in this sector that have done count COVID lows. A lot of these stocks have done 500 to 800, no problem, %.
Yeah. I'm just talking about the ones that are, established.
Right.
UEC, Energy Fuels. What's Energy Fuels market cap? It must have tripled or quadrupled. Look at Centrus. My God, Centrus was trading at $4. It's regularly between $20 and $25.
Right.
This is pretty. Like you said, if you missed it, then but there's still more down the road. But they've done quite well.
Yeah, I don't think anybody's missed it here. I think this is a very small sector and there's a lot of room to run. Jim, I suspect, maybe just confirm for the audience, my suspicion is you have some portfolio of exposure to uranium.
Oh, I do. I think it's have had exposure for many years. I that's why I'm saying I'm very happy with the benefits of this market turnaround. It's sort of icing on the cake for me.
Well, Jim, let's wrap up here. We've taken a lot of your time. Really appreciate you hanging in here. For parties that are listening that want to get in touch with you, or for those that are looking for services such as advice from you or trading services from Traxys, given your relationship with them, what do you offer and how can they reach out to you?
Well, in respect to Traxys, we over time we've managed accounts for a number of hedge funds. We are at a fairly nominal cost. We will manage accounts and do and hold inventories for companies that really don't want any visibility, and we'll buy and sell it based upon their instructions. We've also done a lot of banking for uranium producers. We can provide financing cases. We can provide marketing and sales and logistics support. And Your Energy, we basically standing ready to address any utility uranium requirements, be that here in the U.S. or around the globe. So Your Energy is on standby. They are fully permitted. They're a legitimate low-cost producer. They've proven that their results have been audited, so that those operating costs are not just something that basing on some consultant's report. They're actually well established, and they're licensed to produce up to 2 million pounds, plus they can process another 2 million if that's available to them from other production outside of their operation. So you're talking a production capability between 2 and 4 million pounds at cash costs, somewhere between $10 and $15 a pound. Probably could be even lower if those volumes would be reached. So, I mean, both companies are, well positioned to, take advantage of this, the recovery in the uranium market and in the nuclear market in general. And my email is jcornell@NuCoreEnergy.com. Be happy to, and if people just want to call up and chat, I welcome any type of inquiry.
Jim, I appreciate that. And this has been really insightful. I think our audience are going to like it. I really appreciate you taking the time with us, and let's do it again sometime.
Well, thank you, Andrew. I really appreciate it. You did you're a great interviewer.